Imagine this. You finally decide to buy a home, you crunch the numbers, you think you're ready, and then you hit a wall. Not just because of high prices, but because there simply aren't enough homes for sale. Sound familiar? Something strange is happening in the housing market right now. And if you're wondering, why won't things just go back to normal? You're not alone. Let's set the stage. For years, home ownership felt like the ultimate goal: stable, safe, smart investment. Then interest rates jumped. Prices went ballistic, inventory plunged. What used to be a predictable cycle of buying, selling, moving up started to clunk. And we're in one of those unusual phases now. Not quite boom, not exactly bust, but weird unsettled. And that means for buyers, sellers, investors, even people renting, there's big uncertainty. So, what's going on? Why are prices still high even with high mortgage rates? Why are fewer homes being listed? Why is every for sale sign feeling like a gold coin? Let's unpack this. First, demand, supply, classic economics. The demand side of housing is being hit by high borrowing costs. When 30-year mortgage rates go from, say, 3% to 6% or more, affordability slams. Your mortgage payment might double. Your budget shifts. That means some buyers step back. That's one side of it. But here's the kicker. The supply side is even more jammed. According to a recent analysis, the U.S. is short by millions of homes, and that shortage is a major reason prices remain stubbornly high even when demand is softening. Then there's something called the lock-in effect. It's easier explained with an analogy. Imagine you have a really good deal on something, maybe a smartphone you got for under cost. You're unlikely to sell it and buy a new one at a worse price. Many homeowners are in that position. They locked in ultra-low mortgage rates in the past. Now, they'd have to give those up to move to a new home with a higher rate, so they stay put. Result: fewer homes for sale, fewer options for new buyers. Fewer sellers means tighter supply. When supply tightens and demand doesn't fall enough, prices go up, or at least don't fall. A study from the Federal Reserve Bank of Philadelphia shows that mortgage rate increases have prevented millions of transactions and lifted prices by 5 to 10% in some segments. So far, high rates hitting demand, but supply being constrained even more. That's a major piece of what is happening. Next, policy shifts that could shake things up. Big one, the Fannie Mae announcement. Starting November 16, 2025, Fannie Mae eliminated the minimum 620 credit score requirement for loans submitted to its automated underwriting platform. That means borrowers who were previously excluded because their score was just under threshold may now qualify, assuming other factors check out. Lenders will evaluate a broader risk profile: payment history on rent, utilities, phone bills, plus employment, reserves, debt to income. It's a shift from "you must have 620" to "let's look at your real financial behavior." What does that mean for the housing market? For one, it might nudge demand a little bit higher. More qualified borrowers means more potential buyers. One economist described it as a small positive demand shock. But small is important. In a market where the supply side is super tight, even a small uptick in buyer eligibility can make waves. There's another policy piece: the idea of mortgage portability. The concept: imagine you locked in a 3% rate on your current home. Under a portability scheme, you could carry that mortgage to a new property, then simply finance the extra cost with a new loan, rather than paying today's 6 to 7% rate on the whole loan again. That's huge for homeowners wanting to move up. It could unlock inventory, because right now many homeowners are stuck, unwilling to sell because the new rate would be much worse. Portability could encourage them to move, but there's a catch. This breaks the traditional banking model of how mortgages are financed and risk managed. Lenders expect loans to be paid off over time, allowing capital to be recycled. If everyone keeps their low-rate legacy loan for decades, banks are stuck in low-yield long-term obligations. They'll need to raise rates on new loans or expect government support. This model isn't just easier, it's structurally different. Okay, we'll dive deeper in part 2. So far you've got demand suppression, supply constraint, policy shifts, but the story doesn't stop there. Something deeper is happening. Shifts in housing as investment versus housing as home. Households are buying, holding, upgrading, renting. Investors are buying construction costs, zoning, labor shortages, regulatory constraints. All these slow how fast supply can respond. The economics of housing supply aren't the same as widgets in a factory. For example, even if you say build more houses, you can't snap your fingers and produce them overnight. Land needs planning approval. Labor and materials need to be secured. Developers need the economics, profit, to make it worthwhile. When input costs are high, margins are squeezed. New houses may cost more to build than existing ones, which keeps new home prices high too, meaning older homes keep value too. So even if demand weakens a bit, supply may not surge to meet that, keeping everything tight. One more piece, affordability. Many buyers are simply priced out. When median home prices go up and mortgage rates are up, the monthly payment is much higher than it was a few years ago. A recent estimate, before the pandemic, with the median home at roughly $260,000 and rates around 3.8%, monthly payments might have been approximately $1,000 today, with median closer to $420,000 and rates approximately 6.4% plus. Monthly payments are above $2,100. That means many buyers cannot participate, which cools demand. But since the constrained supply still exists, it doesn't necessarily lead to big price drops. So let's get concrete. Picture a city like Austin, Texas. Homes are scarce, demand is strong, and prices keep climbing. Why? Because even if buyers qualify, there aren't enough listings, and the people who could sell are stuck with ultra-low mortgage rates. They aren't moving. That's the lock-in effect in action. Zillow.com. Now add Fannie Mae's removal of the 620 credit score floor. Suddenly, people who were invisible to the mortgage market are now eligible. First-time buyers with limited credit histories, maybe they've always rented, paid rent, utilities, or phone bills on time, can qualify. That brings more buyers into the pool, more competition for scarce homes. Prices could stay elevated or even rise locally. Here's an example. Sarah, a 29-year-old nurse, has never had a credit card, only rental and phone payments. In the old system, she'd be denied a conventional loan. With the new rules, she now qualifies. If hundreds of thousands of buyers like Sarah enter the market, demand nudges upward, but the number of homes isn't increasing. Prices are unlikely to drop significantly. Let's talk mortgage portability again. Imagine a homeowner with a 3% rate on a $400,000 home. They want to move to a $600,000 property. Today, they'd have to refinance the full $600,000 at today's 6 to 7% rates. That's a huge payment jump. Most would stay put. But with portability, they could carry over their low-rate loan for the first $400,000 and only finance the $200,000 difference at current rates. Suddenly, selling becomes viable. Inventory opens up. Theoretically, that could create a surge in homes on the market. But, and it's a big but, banks aren't thrilled. Mortgage investors expect loans to roll over every decade or so. If everyone keeps their low-rate mortgages for decades, lenders' capital is trapped at low yields. That's what creates systemic risk, like the pressure that contributed to Silicon Valley Bank's collapse. Banks could respond with higher rates on new loans, stricter underwriting, or even require government intervention. The policy sounds good for homeowners, but it's complex behind the scenes. Now, let's zoom out. None of these solutions, credit expansion, portable mortgages, raising loan limits, actually fix supply is the real bottleneck. Builders are constrained by zoning, materials, labor, and profit margins. Even if every buyer were qualified and willing, if developers can't build, affordability remains a problem. It's like turning on the water tap when the pipe is clogged. The water just can't flow. HUD.gov. Consider new construction costs. Lumber, steel, labor, all have increased substantially. In 2025, average construction costs for a single-family home are up roughly 25 to 30% compared to 2020. That means developers must charge more, keeping home prices elevated even for new homes. Let's put it all together with a scenario. Imagine a first-time buyer in Chicago. They're qualified, but inventory is tight. Even with Fannie Mae's credit rule change, their options are limited. If mortgage portability passes, some mid-market homes open up as older owners move, but supply constraints keep new listings scarce. High demand plus constrained supply equals high prices, slow transactions, competitive bidding. That's exactly what we're seeing in cities across the country. And this isn't just theoretical. Data from Redfin shows that active listings are down roughly 20 to 30% compared to pre-pandemic averages in major metro areas. Sales are slower, but median prices are barely budging, or even rising slightly in some regions. Redfin.com. Investors are noticing too. Rental demand remains high as buyers struggle to enter the market. Multifamily construction is growing, but it's still nowhere near enough to meet demand. Renters are squeezed. First-time buyers are frustrated. The market feels stuck in a strange equilibrium. And here's where it gets interesting. Some economists argue we could be entering a two-speed market. High-end homes may see less pressure because wealthy buyers can absorb higher rates. Mid-market homes, where most first-time buyers compete, will remain tight, prices elevated, bidding wars frequent. Meanwhile, new supply for entry-level homes lags, keeping the cycle going. By now, you might be wondering, is this going to crash? Are we headed for another housing bubble burst? The answer isn't simple. Unlike 2008, lending standards today are tighter. Risky subprime lending isn't driving the market. Defaults are low, but structural issues, supply shortage, affordability, and rate shocks mean price corrections, if they happen, will likely be uneven and slow rather than a free fall. All right, let's wrap this up. We've seen it all: demand shocks, supply shortages, policy tweaks, and homeowners locked into ultra-low rates. So what does this mean if you're watching right now, trying to figure out the housing market puzzle? First, if you're a buyer, patience is your friend. Inventory is tight, prices remain stubborn, and bidding wars are still very real in many areas. Fannie Mae's credit rule changes may help some first-time buyers qualify, but the fundamental problem, the lack of homes, isn't going away overnight, so strategize. Look beyond the most competitive neighborhoods. Consider alternative financing or even waiting for potential policy shifts like mortgage portability, but don't expect the market to suddenly ease. For sellers, the situation is tricky. You might have a low-rate mortgage that makes moving expensive. Selling could mean taking a higher-rate loan on your next home, unless portability policies change. But if you can navigate it, this is actually your leverage. Fewer listings mean competition is stiff, and your home could command a premium. Timing and strategy are key. Investors should pay attention to the rental market. With buyers constrained, rentals remain strong. Multifamily developments are growing, but supply is still lagging. If you're investing, focus on locations with tight supply and high demand. These markets are likely to outperform. But here's the big takeaway. All these policy changes, credit adjustments, and potential mortgage portability rules are just tweaks. They try to push demand, but the real solution is supply. Without zoning reform, construction acceleration, and easing regulatory constraints, affordability issues will persist. Think of it like trying to fix traffic by giving more drivers better GPS. Helpful for some, but it doesn't create new roads. And that's the reality for the U.S. housing market. Until we build more homes, we're going to live with high prices, frustrated first-time buyers, and locked-in homeowners. Policy nudges might relieve some pressure, but they aren't a cure. So what's the bottom line? The housing market isn't broken, it's constrained. High prices aren't necessarily a bubble ready to burst. They're a reflection of the underlying supply-demand imbalance. Interest rates, credit rules, and mortgage policies shift the edges, but the core problem is structural. Solutions exist, but they take time, planning, and political will. If you take one thing away from this, pay attention to supply, not just rates or credit changes. That's where the market will really change over the next decade. Whether you're buying, selling, or investing, understanding these dynamics is your competitive advantage. So here's the question for you. Given all this, would you buy now, wait it out, or invest in rentals? Drop your thoughts in the comments. If this video helped you understand what's really happening in housing, hit like, subscribe, and check out our other videos where we break down complex financial and economic trends in plain language. Because one thing is clear, the housing market isn't slowing down in lessons learned. It's just evolving, and the more you understand, the better you can play the game.